I didn't quite understand the sales and marketing component in the beginning, but it was helping people, kind of realize the dreams that they have. The first was financial. The next was kind of health and wellness. And then the end of that story was I won a trip to meet Alex and Layla Hormozi at GymLaunch. I was a client of theirs in the beginning. And then literally sitting at their dining table in Austin, he said, "You're in the wrong opportunity vehicle."
Welcome, millionaires and future millionaires. You're listening to the Millionaires Unveiled podcast, a show where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their portfolio allocation. Now to your host, Jace Mattinson.
Welcome back to another episode of the Millionaires Unveiled podcast. This is episode number 376.
This is the podcast where everyday millionaires share the real stories behind their wealth, how they built it, what they invested in, and the missteps they encountered along the way. We're your hosts, Jason Stacy, and we're diving into candid conversations with people who might just be your next door neighbor. Our guests will uncover how they transformed modest savings into significant wealth, offer investment tips that could change your financial outlook, and share personal stories that might surprise and inspire you. So tune in and get ready to discover how regular people like us turned their aspirations into achievements. And don't worry, while we dig deep for the details, we keep it all family friendly.
Today, I'm super excited for our guest. His name's Tim. He's got a net worth in the multiple seven-figure range. Doesn't exactly give a number, but we can deduce that it's $2+ million. And he's got quite the journey. He is definitely our youngest millionaire. Became a millionaire at the youngest age we ever had on the show at 24 years old. And he worked in the hedge fund industry and then the gym industry, and now spends most of his time essentially as an investor. So quite the career trajectory. He discloses a lot. One of the crazy things is how he spent a bunch of his money on cars, which I think sometimes gets a rap for being one of those things that people spend money on that causes them not to be able to invest. But at any rate, Tim gets into the details of that. Going to be a great episode with him. If you're interested to be on the show, send us an email, millionairesunveiled@gmail.com. Still looking for our 400th episode guest. Hopefully we can find somebody with a net worth of $400 million or more to keep the tradition going with 100, 200, 300, and now 400. So if that's you, send me an email. We'd love to chat and get you on the calendar. And with that, let's get right into the episode with Tim. Tim, do you want to just give us a little about your background and what you're up to now?
Yeah, so my name's Tim Calise. Started my professional career in finance. Started a hedge fund in my early 20s, which grew from zero to over $350 million in equity in advance of the 2008 stock market crash. So we voluntarily gave all the capital back and then transitioned from there into technology and fitness for about a decade, which led me most recently to being recruited to the executive team over at GymLaunch, along with some folks that people know these days as acquisition.com, Alex and Layla Hormozi. And we built that business and exited a couple of years ago. And now I'm an investor, consultant, coach in financial education, helping sub $5 million a year business owners realize the dreams in there and uncover value inside of their own business. So that's where I'm focused on at the moment.
Wow, what a career journey so far. Congrats to you. This is awesome. I want to get into all the details there and really kind of get to the story and the roots, especially starting a hedge fund in your 20s. That's pretty remarkable. Yeah. But before we do, what's your net worth today?
Multiple seven figures at the moment.
Nice. And what's kind of the asset allocation amongst all that?
Yeah. So right now I am 50% plus or minus in equities. I have about 15% in private, not businesses that I'm involved in. And then the rest right now is in cash and other hard lending options. So at the moment.
And do you have any, I guess, the hard lending on real estate assets? So that's kind of how you have your real estate exposure, or just no real estate exposure for you?
Yeah, I actually just sold. We had two investment properties that we sold. We've sold in the last 24 months or so. So now just have primary residence, which I'm actually in the process of selling as well. Moving to much more of a cash flow focus rather than an asset focus at the moment as it relates to real estate. So investing primarily looking at multifamily. I have a number of syndicators and sponsors that I work with, and looking to allocate some into self-storage and some other areas where I can get some tax advantage.
Huh. The money that you have in equities, is that in publicly traded companies then?
It's a combination of stakes in small companies as well as some publicly traded equities. So warrants, options, and equity in private businesses as well as some publicly traded equities.
How much do you think is allocated just to public equities?
Of the 50%, just by nominal value, because options and warrants, things like that, don't become fully realized until the future. It's probably 35% to 15% if you want to break it out of that
Wow.
50.
Wow, that's quite a bit. Has it always been kind of in that asset allocation with the public equities, given that your background is really, I guess, with the hedge fund? What was your strategy with your hedge fund? Maybe that's
It
what I
was
should ask first.
long short equity. So
Okay.
for me,
Okay.
I stick with what I know. So
Okay.
I don't have a real estate background, but I have found people that I trust to put some money into deals that they've done. So
Okay, that makes a little more sense. So
yeah.
you've got very much a tool belt, if you will, as it relates to public equities. That's why you're still kind of in those.
Yeah.
Typically, I feel like when I see people start investing much more in private businesses and private enterprises, which you also have a lot of experience doing, I feel like they tend to lean towards that way. But you've got kind of a nice mix of both, given your background.
Yeah. If you go back 3 or 4 years, it was 90% of my net worth was in private businesses, but I've divested from just about all of those. So now my kind of portfolio is comprised. I don't have a big operating business anymore. So I've exited a couple of those over the last couple of years. And so I've turned that cash into publicly traded equities and starting to rotate into real estate and some other things. Because right now I'm looking for cash flow and tax mitigation.
Yep, makes sense. So is any of that money that's invested in public equities or even the private, is it in tax advantaged accounts, whether that's a Roth or traditional IRA?
So I do have some remaining, but I am a believer in the infinite banking concept, and so I'm rotating some of that into that. So I've stopped contributing to those tax advantage accounts and starting to spin up more of for those that are familiar with the infinite banking concept, using basically an insurance vehicle to house money and be able to use that as a facilitation mechanism going forward.
Cool. Well, let's kind of go rewind here and get back to Tim in his 20s. Did you go to college?
Did. So I was always entrepreneurial. I was the kid in like the early ages that was always tinkering with things, coming up with business ideas, selling things, lemonade stands, trading baseball cards, all of that kind of stuff. And then in college, I actually started a late night snack delivery business my sophomore year in college in Washington, D.C., which ended up being a pretty successful endeavor. I sold to my partner about within the year that we started it. But then I started a hedge fund after college, which was right place, right time, a lot of naivete, didn't know what I was doing, but definitely worked really hard to make something happen, and the stars aligned for me.
So you're 22, call it? You're starting a hedge fund?
Yep. And we started with $700,000 of friend and family money with a partner.
Wow. That's pretty wild. So tell us about kind of, you say you're entrepreneurial, but going out and starting a hedge fund most people go spend a little bit on Wall Street before they go make that jump to start their own fund. Talk us through kind of the mindset that it took for y'all. Hey, I'm going to go raise $700,000 in family and friends and then grow this thing to 350.
Yeah. So the step in between college, my sophomore year in college, I started that late night snack delivery business. And I also was introduced in an economics class to a guy who was an intern at what was a division of Citigroup, Solomon Smith Barney at the time. This is almost 25 years ago. And it was like a retail brokerage, like a Morgan Stanley or JP Morgan or what have you. And so I worked there as an intern for like a year. And I realized I did not want to be a stockbroker for the rest of my life. And so I had a great mentor and boss at that time. And he said, you really should go do something else. And so he actually hooked me up with who ended up being my partner. And so I moved to Birmingham, Alabama, of all places. And we started with 700 grand in the back of a CPA's office. I wish I had taken a picture because it was literally a card table with 2 computers on it. And then at that time, hedge funds at that time, just to give context, is a little bit like what Bitcoin and crypto is like right now, like over the last 24 months. Like everybody was starting to know about them. It was on the front page of every major publication. It was where all the hot money was going. It's where a lot of the kind of rotation of money was moving. And so we were in kind of the go-go area of finance at that time. So for me, probably in my early 20s, I was like, I can make a lot of money at some point if we can make this work. But it was a relatively low probability. But yeah, from that point, had a strategy, ended up having a pretty good track record. And then I was just on planes meeting as many investors as I possibly could for the better part of about 2.5 years. And the way that business works is when you're small, you can only take small allocations of money. So if you have $5 million, you won't find an institution that'll give you, $20 million, right? You can only raise a little bit at a time. So that's what the first 2.5 years was. And then in 6 months, we raised over 150 million from some large institutional investors. So the big growth was at the end.
Yeah, that's pretty remarkable though still. And operating a hedge fund in Birmingham, Alabama, that's got to be something. I know it's a little bit of kind of a southern financial center, but it's definitely not what you would expect, right?
And it was part of our story actually. It's like you use the things that you have to your advantage. And part of it was we said our whole strategy was like hitting singles every month. We're never going to be up 60%, 50% a year, but we're never going to be down big. And so we just said we were going to hit like 1 to 1.5% returns every month like clockwork. And part of the reason and the story of being in Birmingham was we're outside of the financial center, so we can literally distance ourselves from all the noise that everybody else is getting caught up in. We can just sit here and do our, run our strategy and do what we feel like is the right thing and the prudent thing to do for our investors. And our investors actually really liked it. So many of them came to visit us. Many of them didn't. But it ended up playing very well to the story and actually insulated us from a lot of the kind of the groupthink that happens on Wall Street specifically.
So how many years later until 2008 when things went belly up quick?
So we made a market call. I called all of our investors October of 2007 and said we were going to cash because our strategy, just to kind of very broadly, our strategy required what we'll call a normal market climate, which means, certain things would go up, certain things would go down, but behaviorally, like the market worked the way that it generally does. In 2006, end of 2006 and most of 2007, the market didn't operate that way. And for context, this is where like mortgages started to default. Ben Bernanke in the spring of 2007 was talking about how Alt-A mortgages were, the contagion was going to be, it was all going to be contained and all that kind of stuff. But really the dominoes had started to fall. And so we went to cash at the end of 2007. We waived all of our fees. And we told all our investors that we want to keep the money with us and we will jump back in when we think it's right. I said, or you can take your money and, no harm, no foul. And everybody said, you guys have lost your touch. Everyone else we talked to says that the market's going to be fine. And so 12/31 of 2007, we basically gave it all back and started over again.
Holy cow.
Yeah.
So how many years were you essentially operating the hedge fund before all of a sudden closing the doors in the last day of the year in 2007?
Basically, it was 2003, 2004 up to the end of 2007. So it was like three and a half years.
Pretty quick little stint. And then all of a sudden you find yourselves essentially call it out of business.
Yeah. We basically shut it all down and, there's legal requirements, right? So you have to like do tax and audit and all of the things that come with being a professional money manager. So all of that took me to June of 2008. And at that point, the market had not really kind of fallen apart yet. So we're all looking at each other going, we stuck to our principles, but maybe we were wrong. Were we overly conservative? And then by September, October, everything kind of came to pass. So That's how the story ended for that chapter of my life.
Wow. So talk to us about the next transition going from there to everything you've done with GymShark and everything else. Walk us through that journey a little bit.
Yeah. So I think, and you referenced it earlier in the conversation, like I believe risk is just like going into things you don't understand, right? So for me, one of the things that I knew was I was always kind of a technology guy, and my wife and I were Division I athletes in college. So we knew fitness and I knew some things about tech. And so I was introduced to a tech-enabled fitness franchise, actually based in New England. And so I called them and said, I love what you're doing. I'm an investor. Would you take are you looking for investment? And he said, we're fully funded, but we're starting a franchise. Like we have these franchise opportunities. Maybe do you want to build a gym business? And so my wife and I decided to do that. And so from 2009 through 2018, we built a 8-unit, multi-7-figure a year gym franchise. And then in 2018, we actually ended up buying out the parent company, and it still exists today, but we have that in a holding company as well.
So how long did you operate the gyms then?
About 10 years.
Wow, that's pretty long.
2009 to 2018. Yeah.
So you were rocking and rolling with the franchise, and I'm assuming that did you bet all your capital on this after you closed up the hedge fund?
No, I in the beginning we put some equity in. The thing about the gym business, which I didn't fully appreciate, is it would be the equivalent. It's like the E-Myth book. Like I was like, I'm an athlete. I know technology. We can make this work. The problem is the business you're in when you get into fitness is you're in the sales and marketing business. And that was something I didn't understand going in. I was like, we can just have cool technology and the people, if you build it, they will come. And it didn't work out like that. So in the beginning, we put some equity in, and then we opened up multiple locations relatively quickly. And so we ended up having to almost double our investment to see it through. And it ended up working out, but probably wasn't the most efficient use of capital for a decade.
You should know what that is. That's the best kind of notification. That's the sound of another sale on Shopify. And the moment another business dream reality comes true. Shopify is the e-commerce platform revolutionizing millions of businesses worldwide. In fact, I use it for several businesses that I have and my wife has. We love Shopify. Shopify simplifies selling online, and you can focus successfully growing your business. Shopify covers every sales channel from in-person POS system to all-in-one e-commerce, and it even lets you sell across social media marketplaces like TikTok, Facebook, and Instagram. Packed with industry-leading tools ready to ignite your growth, Shopify gives you the comfort, your business, and your brand without having to learn new skills or design new code. And thanks to 24/7 help and an extensive business course library, Shopify is there to help you have success every step of the way. Sign up for a $1 per month trial period at shopify.com/unveiled, lowercase. Go to shopify.com/unveiled to take your business to the next level. Once again, that's shopify.com/unveiled. And thanks again to Shopify for sponsoring today's episode.
So talk to us about the next transition, because you've had quite the stair step of kind of from here to here, finance to then operating gyms. I mean, you had the background as a D1 athlete, so it makes a lot of sense going that. But operating a gym versus pulling a long short equity and then the next transition is pretty wild to me. It really is.
Well, I mean, so the through line for me has always been it's like a relationship-based sale. And I think this is fundamentally, like, if I look back, the hedge fund that we built, we figured out a unique selling proposition, which was this, like, we're going to hit singles. It's not like swinging for the fences. And because we were so small and quite frankly, just we didn't know any better, I was like super communicative with our investors. Like I would call them every week and just check in with them and things like that. And that actually unlocked a ton of new allocations for us. And our referrals were off the charts. Like people were bringing other investors to us because they had such a good experience. And so take that and then move to fitness and technology, which is really a service business, which is trust-based. It's all recurring revenue. I didn't quite understand the sales and marketing component in the beginning, but it was helping people, kind of realize the dreams that they have. The first was financial. The next was kind of health and wellness. And then the end of that story was I won a trip to meet Alex and Layla Hormozi at GymLaunch. I was a client of theirs in the beginning. And then literally sitting at their dining table in Austin, He said, "You're in the wrong opportunity vehicle. You're far too smart to be doing what you're doing." And his words, not mine. I said, "So what do you think I should do?" He said, "You should go sell your gyms." So that's effectively what we did. And then he recruited me to come work alongside him at GymLaunch shortly thereafter. So the transitions really were finance, investment mindset turned into operator, gym, tech, sales, and marketing, which then led me to being the VP of business development for GymLaunch, which was a coaching consulting business, which was all around how do we unlock value as operators in a fitness business. So it all kind of actually came together at the end.
And how long were you working with them at acquisition.com?
So this was before acquisition. This was before they started acquisition.com. So this was, for those that don't know the story, GymLaunch was the fastest privately held company, fastest growing privately held company in the United States. They went from zero to $35 million a year in revenue in under 2 years from basically a standing start. So I joined in 2019, and then the business was sold in 2021. So it was a couple of year run.
Wow. So, which takes us up to kind of what you're doing today, why after all that, you're still pretty young. Why do you make the transition that you are in today?
The thing I enjoy the most, and I think this is something that I didn't pay attention to for probably close to 10 years, was people talk about what your zone of genius is. And as an investor, the same thing is like, what's your investor DNA? Like, what is your point of view on the world? Because let's just use reviewing investments. I could look at an investment and say, this is great for me. You could look at an investment and say, this is a terrible fit. So the question is why? Because we each have different points of view, different sensitivities, different opinions and backgrounds. So for me, the reason I kind of transitioned out of being an operator, the thing I love doing is helping kind of conceptualize businesses. Like I can see the gaps. And I remember very vividly in 2013, laying in bed, staring at the ceiling above my bed, sweating at 2:00 in the morning, when we were literally on the brink of bankruptcy because I had bet a bunch of money on our fitness business. It wasn't panning out the way that we wanted it to. And if things didn't turn around, we were going to be in a really tough spot. And so I speak to now in my current state, that person who doesn't have anyone to kind of reach out to or counsel them. And most businesses can be fixed. Most people are just petrified and don't know what lever to pull. And so that's what I spend my time doing right now is some version of personal and business financial education mixed with being able to help kind of influence the growth of service businesses generally under $5 million a year in revenue. A lot of them are under $1 million.
And do you think this is something you'll probably do forever?
I believe I will. I'm an investor at heart. My first investment I ever bought was Yahoo at the peak, pre-2000. I still have the scars, the whole so I've been through multiple kind of market cycles. I love the game, to be honest. And going back to the hedge fund, one question I get asked is like, what's it like to have $350 million of capital at 23, 24? The cooler part was when you have money, banks will lend you tons of money too. So at 24, I had $1 billion line of credit that I could use to invest. And they're just numbers. So like it goes from being like the idea of capital of money to a scoreboard. And I've always been super competitive. And so I like the challenge of helping unlock value and watch the scoreboard move in our favor. And that's something I think I'll do forever.
Yeah, absolutely. That's pretty wild to have $1 billion of capital essentially as a 24-year-old. I mean,
it was zero. It was basically a zero interest rate environment and the banks were lending. So
yeah.
They're like, if you give us 300 million to 350 million, we'll give you all the capital you need to do whatever you want to do, which is how we ended up in 2008 in a large respect.
And I can't imagine with the baby face you've got now that it looked any different back then, if not better, right?
It's one of those funny things. And this is partially why kind of the financial industry has turned the way that it has. I did most of the stuff I did on the phone. If I was in this environment, I couldn't do what I did in the Zoom, FaceTime environment. I just couldn't. Because what would happen is investors, I would have been 22, 23. Investors would say, let's get on a Zoom call and talk about it. And then they would realize I'm 23. So instead, over the phone, it didn't matter. Nobody cared. So I actually think I came around at the exact perfect time because I couldn't replicate it today.
That's wild. Yeah, it's not every day you really hear about, and I audited hedge funds ironically back in the day.
Yeah.
And that's a completely side note, but I just look back to some of those that I worked on, and I'm like, I just can't imagine that, the capital was getting pumped into those things. Even heck, I was even after 08 that I was doing that.
Yeah.
But you're right. I mean, getting something like that today, people would just be probably a lot more cautious. The due diligence is different. The expectation of like getting on camera constantly, in our new society.
Exactly.
But hey, kudos to you, man. It's been awesome.
You gotta, what do they say? When you make hay when the sun is out, or strike while the iron's hot, whatever analogy you want to use.
That's exactly right.
I think it was like, for whatever reason, the universe like aligned that opportunity with that time, because I was just in the right opportunity vehicle at the right time.
Do you know what age you became a millionaire?
24.
Hit it 24. And did you stay a millionaire even after closing down the hedge fund?
Yes. The time that you could on paper say that I dipped below it was in the beginning part of my gym business. But then after that, I've maintained a 7
nice.
or 8 figure plus net worth since then.
That's awesome. Congrats. You'll probably be our youngest ever. I think 28 was, but you're going to beat that.
Well, that was, and the reason was, I mean, you audited hedge funds. So like the basic economics of a hedge fund are you get on average, 1 to 2% of whatever capital you manage as a fee to show up for work every day. And then for us, we kept 20% of all the profits,
which is
pretty standard terms in the hedge fund world. So when we hit $100 million, we were averaging about 18 to 20% a year. So you do 20% on 100 million on, quote unquote only, that's 20 million. We kept 20% of that. That's 4 million. And I owned a piece of that.
Yep. No, it's awesome.
Plus the salary. So it ended up, I was in the right place at the right time and worked myself to do it. But got to meet some really influential people, which was a fun story along the way.
That's cool. Did you end up increasing lifestyle along that, getting all that capital in your 20s, or was it, hey, I'm nose of the grind, I'm still going to live in the $500 apartment, live across the street from work, etc.? Or did there some lifestyle creep start to happen then?
What a good question. People, the other version, I was like, what would I tell my 22-year-old self? I would basically say, get a therapist and figure out why you need to impress everyone. Because I fell absolutely into that trap of like, okay, I've got money, this is going to go on forever. And I spent it. In some cases, I mean, I built houses and stuff like that, but like cars and things like I'm a car guy. So cars were probably the part that have kind of cost me the most over the last 20 years for sure.
What car did you buy when you started making the dough?
I've had many along the way, but everything from, I got married shortly thereafter. So, we bought new, Chevy Tahoes and that kind of stuff. And then when it got really fun, it was, I've had a number like BMW M3s, that kind of stuff. So I like sports cars personally. So
Ferrari, Lambo, or anything like that?
I never dipped my toe in. I'll say smart enough, which is probably not the right phrasing. I guess I lost my mind only like halfway. I didn't go full. Like
I'll spend $100,000 or $200,000, but not 400 or 600,
something like that. I was going to say that was my rationalization, I guess. So but
hey, man, good for you. You earn it. I'm a car guy too. I haven't bought one yet, full disclosure, but I will be. At some point in my life, definitely. Yeah, I definitely enjoy them. They're fun.
Well, it's funny. I have 3 kids now, and so I do the like time value of money thing with them. So they're like, I really want this, $100 thing. I'm like, I like literally gave them a calculator once, and I'm like, plug it in and see what $100 is, 40 years from now with a 8% rate of return or something. And they're like, oh, it's $2,000. Man, that BMW M3 when I was 25, if I had just not spent the $75,000, would probably be, even at 8%, let alone doing anything crazy, would be, $1 million or something.
Wow. So as an investor, I'd like to ask this question to people that do a lot of what you do, but typically when you underwrite and when you're thinking about your investments, what rate of return makes it interesting to you? What point is it not interesting to you?
It's a really good question. I just had this conversation with somebody yesterday, and this might surprise some people. My base rate of return is 25% a year, almost low risk. My target for just about everything I'm doing right now is it has to be at least 40% plus, which is very different from the way that most people think. I don't subscribe to the, let's just get 9% a year in the S&P 500. Like my equity holdings right now, full disclosure, like my top return, my top 3 equities represent 90% of my concentration. And one of them is NVIDIA, which I'm just not going to sell because I think it's going to the moon. But that's averaged, I don't even know what, easily 50% plus for the last couple of years. And then I have 2 other holdings, one of which is a long play, and one of which is up 300% this year. So you pick my spots.
You take very strategic.
Yeah, I'm not a spy by the spiders and let it sit. I found other opportunities. And the way I think about it, because I like to think in mental models, there's like the actual rate of return. There's the tax efficiency. There's the collateralization. So like for me, Bitcoin, you could argue that crypto is a great place to be, but it has no tax efficiency and it has no claim to assets. Like it's basically a trade, not an investment, in my opinion. So I like to look at, and then there's time horizon. Like how liquid is it? Because most things, you could buy multifamily real estate and some other things. But if my money's tied up, that's my other consideration. So I kind of think across those 4 pieces: rate of return, tax efficiency, liquidity, and collateralization, or kind of what asset is it? That's why I don't get into crypto, as an example.
Gotcha.
Personally, it might be great, and that's not. I have no, I probably have walked away or avoided, tremendous gains that I could have gotten. It's just not something I understand in a way that, from an investor perspective, is something I would put a ton of capital into.
Yeah, no, makes sense. So, in terms of like how you allocate your household spending, do you peel off a little bit from the investments? You take like income in from what you're doing generally, or how do you kind of think about that being kind of more of an investor than somebody who's getting real estate income? You're selling everything right now. You know what I mean?
That's because it's kind of an investing conversation. Like I personally believe that right now is the time to have more cash on hand. I don't know what's going to happen. So to use those kind of 4 levers I just talked about a second ago, I'm holding more short-term. I'm having more liquidity now. Like a home, for example, is tough to sell, and who knows what'll happen. I can't turn it into cash very quickly. So I'm doing short-term loans, like 30 days or less, which are so that's kind of, I'm doing a lot of that because you can get really high rates of return and I can get my capital back very quickly. So that's why I'm doing, just to answer the question of why am I getting out of real estate? I'm getting out of residential real estate primarily. I still like multifamily and some other things, but that's what I'm doing right now. But to answer the first question you said was, how do I think about my own personal stuff? All income goes into a bucket. Every month, I make like one transfer out of that bucket to an operating account, and that is where all of my bills get paid out of. So active income, passive income, investment income, it all effectively flows into one place. And then I just control whatever that one draw is how I know whether I'm over, quote unquote, out of budget or below budget. Because if that operating account goes to 0 and I need to make another transfer, it means that we've done something out of the ordinary. So it could be like we went on vacation or we bought something or whatever. But I know generally what our monthly expenses are. And so I believe financial freedom comes when your investment income, passive income for most people, exceeds your monthly expenses.
Yeah,
and that
absolutely.
That is the thing that I would tell anybody is before you do anything, get your investment income to exceed what you want your baseline monthly expenses to be, and then you will have no worries in the world.
Yeah, absolutely. Well, let's wrap up with some rapid fire questions. What's the most expensive pair of shoes or pants that you purchased?
Probably shoes. I've got a pair of Gucci loafers that I love. I think they were like $450 when I bought them, but I've had them for 15 years.
Okay, years. Nice. You got some great utility out of those, even at $450. What about the most expensive meal out?
Las Vegas, before what is now the SALT conference, which was Anthony Scaramucci's conference. I went out to dinner. I did not pay the bill, in full disclosure. There were 6 of us, and I think it was $20,000 for 6 of us.
Okay. What about the most expensive vacation or experience?
Ooh, that's a good question. Probably most expensive vacation. I haven't gone on any like really crazy ones. Probably Grand Caymans for a week, rented a house, flew the family down, that kind of stuff. That was probably the most expensive one I've been on.
You remember how much you spent?
It was probably 25 grand.
Okay. What about the best lesson that you learned from childhood?
There's always another deal.
Okay. What's the craziest thing that you've ever done to earn money?
Craziest thing to earn money. So I mentioned I started a late night snack delivery business. When we started that, it didn't really go very far. Like we were doing like late night ordering of like cookies and ice cream and stuff like that. And it really didn't get traction until one day I was taking human sexuality in college because I had to. It was part of like a requirement of whatever. And I went to the professor who happened to tell me that he was the head of the like health services in the area where I went to school. And I asked him, I said, do you do like safe sex campaigns? And he said, yes. And I said, great. I have your core client when you want to be in front of them at the exact right time, at the exact right person. And he said, okay. He goes, well, what do you need? And I said, well, what could you give me? He goes, well, we're doing a safe sex campaign right now. And I said, can you give me a bunch of free condoms? So he donated 10,000 free condoms to our business, and we included one with every order. From that point forward, we became the guys who had the late night snack delivery business that you got a free condom with every order, and business took off. So that I would say probably is the best marketing thing that I've ever done to make money.
That's awesome. How did you make your first buck?
Lemonade stand, like way early. But my parents probably floated that. I traded sports memorabilia when I was a kid.
Oh, nice. Like sports cards,
jerseys, signed stuff. This was like the beginning of eBay. So back in the day when you actually had to go to the bank and take out a bank check and send it in the mail and hope your item showed up.
That's awesome. What's the dumbest thing you ever wasted money on?
Cars.
What's something you spent way too much on but you don't regret?
We bought a house like 6 years ago that was way outside our budget. But it was the right place, the right time, the right situation. And it ended up being the best investment probably we've ever made. Like it was like a double in that same time. So that was probably the worst financial decision because it put on more risk than we should have at the time. But it ended up working out okay.
Okay. Luck, skill, hard work. How would you rank them?
Hard work, number one, because I think luck comes after that. You'll build skills. I think luck is a byproduct of the other two. So hard work, skills become the second, and then luck comes after that.
On a scale of 1 to 10, and this may, you may need to look at each of your phases of your career, but how would you rank kind of your profession, the things that you've done in your career at different times?
Yeah. The hedge fund business was my absolute favorite thing I have ever done. It was right place, right time, had a blast, did it with great people, and it was right in my skill set. So that's probably a 9 out of 10. The fitness business that we built and operated, I had no business actually doing. I learned all the hard lessons of being an operator and doing too much and changing things too often and not trusting people. So the experience was probably a 2 out of 10. The learnings was probably an 11 out of 10 because it forced me to confront all the things, all the belief and traits that I didn't have to actually be successful. So it taught me a lot. GymLaunch was amazing, phenomenal experience, probably an 8 out of 10. Talk about hard work. It was a ton of work, but really fulfilling. And now I feel like I'm in the coaching investing space for me is where I belong. So I'm having a lot of fun doing what I'm doing right now.
What's a closely held belief that you once had that you recently changed your mind on?
I used to believe that the smartest person wins in the end. And I also believed that a lack of success is due to a lack of knowledge. And I now believe that really, I subscribe to the Tony Robbins quote that, like 80% of success is psychology, 20% is mechanics. I think we far undervalue or underappreciate just how impactful mindset belief systems are on the things that we do. So I spend a lot of time on that right now.
Awesome. Any last piece of advice for somebody who's just getting started on their journey?
Yeah. Everybody says just save money as much as you can. Turn into cash flow. Anything you want to do, all the cool stuff you want to do, just figure out how you can get an investment to pay for it. So create an LLC, which will give you all sorts of tax advantages. Even if you have a W-2, create a LLC. It'll be worth it in the end. You'll save taxes and a bunch of other things. Sock as much money into that as possible and look for opportunities where you can make 25% plus a year on your money with very little risk. If you can do that, compound it over even a couple of years, you'll be in really, really good shape.
Awesome. That's Tim with a net worth in the multiple seven figures. Thanks for coming on the show today.
I appreciate it. Thank you.
Thanks for listening to the Millionaires Unveiled podcast with Jace Mattinson. For more stories, investment opportunities, and information, check out our website, millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.